Hi everybody, this is the second video for today lecture. So in this video, or now we are looking at the next section in topic 1. This section is about accounting principles and assumptions in preparing the financial statements. These principles and assumptions are like rules that you have to follow when you want to do accounting record. Okay, let's see. There are 4 assumptions. The first one is separate business entity. The second one is going concern. Number 3, monetary unit. Number 4, time period. And then there are 6 principles: historical cost, objectivity, revenue recognition, matching, full disclosure, and consistency. And there are 2 constraints: conservatism and materiality. So most of the time, all these are called principles in accounting. Principles that we use in accounting. Sometimes they call it assumptions that we use in accounting. Sometimes some textbook they separate these concepts into 3 categories. So basically, for introduction to accounting, every concept here is called principle or assumptions related to accounting. Okay, so let's see the detail one by one. Separate business entity. The first assumption is separate business entity. So for this assumption, it means that in accounting, the owner of the business and the business are different entity. So remember about this. In accounting, we have this assumption, separate business entity assumption or principle. It means that in accounting, the owner of the business and the business are separate business entity. Let's say you start a grocery shop. So from the accounting view, you and your shop are different entity. So the effect of this assumption is like this. When you do accounting record, you do accounting record for your business. You do not do accounting record for your personal transaction. So when you do accounting record, you record the sales made by your business, expenses paid by your business. But let's say one day you repair your car. You have to pay $200. You cannot record that $200 in your business account because the $200 is your expense, your personal expense, not the business expense. The accounting record will record things related to the business, not you, the owner of the business. Okay, so the second assumption is going concern. Going concern assumption says that when you it says that the life of a business the business is presumed to continue operating instead of being closed or sold. You have to assume your business will continue to operate in the future. So the effect of this assumption is when you have a business, then when you assume that the business will continue to operate or exist in the future, you can categorize your asset into current asset and current and non-current asset. Liabilities can be categorized into current liabilities and long-term liabilities. That categories can be made because you assume the business will continue to exist in the future. Okay. Monetary unit. So monetary unit assumptions says something like this. In accounting, you record things that can be expressed in terms of dollar and cents only. In accounting, you record things that can be expressed in terms of dollar and cents only. In accounting, when you record business transaction, you record things that can be expressed in terms of dollar and cents only. For example, you record the building. Building is an asset. You can record that because you can building can be expressed in terms of dollar and cents. For example, this building is $400,000. So you can keep that in your accounting record because it has the value of dollar and cents. But let's say location. Location is also an asset for a business. If you have a business and then you get a good location, it will benefit your business. The good location will benefit your business. You have access to more customer. So location is an asset, but you cannot record the location as an asset. Why? Because location cannot be expressed in terms of dollar and cents. Building can be recorded. Motor vehicle can be recorded. Machine can be recorded. But location, another type of asset is like, let's say, you have very good brand. When you have a very good brand, it is like an asset. Everybody likes the brand. Everybody likes the brand. But you cannot record it in your account because the brand, the value of the brand cannot be expressed in terms of dollar and cents. Okay, so in accounting, always remember we have monetary unit assumption. It means that in accounting, we record things that can be recorded in terms of dollar and cents only. And then we have time period assumption. This assumption says the life of a business can be divided into specific periods such as months and years. Okay, remember before in the previous slide we have an assumption, a going concern assumption. That assumption says we assume that the life of a business will continue to in the future. But here, the time period assumption says the life of a business can be divided into periods such as months and years. Okay. In accounting, we have time period assumption because we want to calculate the profit of the business. If we have only going concern assumption only, the assumption says the life of the business will continue in the future. So how can we calculate profit and loss? The business will continue to operate in the future. So to be able to calculate profit and loss, we have this assumption, time period assumption. We assume that the life of this business can be divided into specific period such as months and years. When we assume that the life of the business can be divided into specific period like months, then we can, when we do accounting record, we can calculate profit for one accounting period. So we can calculate profit for 1 month, or we can calculate profit for 1 year, or for 3 months, or for 6 months. But most of the time, according to the law and regulation, at least every business has to close its account and calculate profit and loss at least once a year. Okay, now we have principles. The first principle that we have in accounting is called historical cost. Okay, the historical cost says assets that are acquired by a business must be recorded at the price paid in the transaction. So this historical cost says in accounting, you record the value of an asset at the purchase price, not at other value. For example, it is like this. Let's say you have a business and then you have purchased an equipment in year 2019. You have purchased an equipment. At that time, when you purchase the equipment, the price of the equipment is $5,000. Now it is year 2021. When you check the equipment, the current value of the equipment now is only $3,000. So when you want to record that asset in your account, you have to record it at $5,000. The value you purchased the equipment in year 2019, or you have to record it at $3,000, which is the value of the asset now. The answer is you have to follow this historical cost principle. In accounting, you record the value of an asset according to the purchase price, not the market value, current market value, or replacement value or not. If you have purchased an asset in year 2019 and your business still use the same asset until now, in the accounting record, the value of the asset still the purchase price that you have paid in year 2019. But there are several things. We have to record depreciation, etc. But the value of the asset in the account is still same at the purchase price. It's recorded at the purchase price. Remember, always remember that. When you do accounting record, when you want to record the value of an asset, record the value at the purchase price, not at the current market value or replacement value or other value. Okay, and the next principle is objectivity. So objectivity means in accounting, you have to disclose objective information in the financial statement. Objective information means information which is true and can be verified by other party. When you prepare the financial statement, you have to report or to show objective value. Objective value is the value that is true and can be verified by another party. You cannot report numbers based on perception or something, but you have to report objective number. Okay, the next principle is revenue recognition. Transactions and events are recognized when they occur, not based on cash received or paid. So in accounting, okay, we have this principle, and this principle explains that in accounting, you record a transaction when it happened. This principle is relevant for revenue. So revenue, if you have a business, you record the revenue when the transaction happened, not when you receive cash from the customer. So the example is like this. Let's say you have a shop, a grocery shop. So and today a customer come and he takes 4 items. The value of these 4 items is 50 ringgit. And then he said, okay, I take these 4 items today, but I will pay at the end of the month when I get my salary. So question is, when is the time to record the $50 revenue? Today or when the customer pay at the end of the month? The answer is today, because in accounting we have this principle, revenue recognition principle. The principle says In accounting, you record revenue when the transaction happen, not when you receive cash. So in the example that I mentioned earlier, the transaction happened today. The customer take the 4 items today. The shop has given the 4 items to customer today. The 4 items has changed hand from the hand of the seller to the hand of the buyer today. So the transaction happened today. Even though the payment will be made at the end of the month, but in accounting, you record the revenue. When the business sells something, the business get revenue. In accounting, you record the revenue when the transaction happen, which is today. So always remember that in accounting, we record the revenue when the transaction happen, not when you receive cash, your business receive cash. You will see how these rules and assumptions applies when you learn about recording in the later chapters. Okay. Same goes to expenses. You record expense when the transaction happen, not when you pay. For example, you have a grocery shop, you have 2 workers. Every month you pay them $1,200 for each worker. So let's say this month is October. So the salary for this month, the salary expense for this month is 1,200 times 2 workers, so 2,400. But your practice is you will pay the salary at the beginning of every next month. Let's say salary for the month of October, you will pay at 5th of November. Salary of November, you will pay at 5th of December. So for this month, at 30th, so for this month, salary for this month, October, is 2,400 for 2%, for 2 workers. So when is the time you should record the salary expense? At 31st of October, or you have to record the salary expense at 5th of November when you pay the workers? The answer is you have to record the salary expense at 31st of October, on the day the transaction happened. You have to pay the salary when you have to record the salary when it happened. So the salary for the month of October has to be recorded in the month of October. So at 31st of October, you have to record the expense, even though you do not pay the cash yet. There is a way to do that. Later, you will learn about it in the next topic. Matching principle. Matching principle says when you want to calculate profit for one accounting period, you have to match the revenue of that period with expenses of that period. So the situation is like this. In accounting, when you want to calculate profit, the basic equation is revenue minus expenses. So let's say you want to calculate profit for the month of October, you have to calculate revenue for the month of October, and then you minus the expenses for the month of October. Then you will get profit for the month of October. You cannot add revenue from month of November or from month of September in the calculation. No. If you want to calculate profit for the month of October, you have to match the revenue for the month of October and expenses for the month of October. Okay, and then full disclosure principle, it says that when you prepare the financial statement, you have to disclose all data and information. You cannot hide data and information. Consistency. Consistency means that when you do accounting record, if you use one method, you have to be consistent. You have to use the same method again and again. And then we have constraint, conservatism and materiality. Okay, conservatism means when you do accounting record, you must not overstate profit or asset. When you report or you list your asset in the balance sheet, you cannot overstate. Also, when you calculate your profit, you cannot overstate your profit. When you overstate your profit, it is like you lie to the people who will use the financial statement. And then you have the materiality principle. The materiality principle or constraint. So materiality principle says you have to place importance on the information which will affect one's ability in making decisions. Okay, if you have a business, when you prepare the financial statement for your business, there are many data. So you have to place importance on the information or data which will affect one's ability in making decision. There's a way to do that. For example, if there are small transactions and the transactions are not important, then you can group them together and record them in one account. For example, miscellaneous expenses. If the item is important, for example, inventory, supplies, buildings, so they are important. You cannot group them together. They are important. You have to show them separately in the account. But if there are small things, small expenses, and they are not very important, so you can group together and give them a name, miscellaneous expenses, for example. When you learn about the recording process in the later chapters, I hope I will show you how conservatism and materiality constraints or principles applies in the recording process. Okay, see here there are several examples of situation, and let's say if you can identify the principles that are relevant for this situation. So A, land worth 70,000 is reported at its original purchase price at 60,000 in the financial statement. So what do you think? Okay, this thing is related to the value of asset. The value of asset, land is an asset. So in this A situation, now the land value is 70,000, but the purchase price of the land maybe several years ago is 60,000. So land is reported at its original price of 60,000. So the principle that is relevant for this situation is historical cost. B, including private costs incurred in running a car as a business cost will violate the principle of this one is related to the principle of separate business entity. C, bought goods from a supplier on credit in December, X1 paid only in February, X2 recorded the purchase in 2000 X1 books. This one is related to matching principle. Matching principle. C is related to matching principle. D, companies usually close their accounts and prepare financial statements quarterly. So this one is related to time period assumption. E, maintenance costs of a rental house are deducted from the rental revenue received each month. This is related to the principle of matching. That's all for this second video lecture. Write your name and metric number in the comment section. I will take that as the lecture attendance. Thank you very much.